Hello, everybody. Hello, Eric. How are you?
Morning, Ed. I'm good. How you doing?
Everything's fine. Thanks for doing a solo performance last week. I managed to take a week off with my wife to Italy. We went to uh, Portofino, which was a beautiful place, but I was a little disappointed. It was kind of like a Disney attraction, tremendous amount of tourists. And once you kind of look behind the first row of houses on the port there, which were beautiful, there really wasn't much going on. We also enjoyed going to the lakes there. Lake Como is also beautiful, but the only problem is it's way too many tourists. It was like a mob scene, and too much pasta and too many stairs. You gotta climb a lot of stairs when you go to that part of Italy. So, anyways, I got some good exercise out of all of it. Eric, how's by you? All right?
It's all good here.
Good. So you're on the West Coast. I'm on the East Coast. I'm already starting to wear a sweater. Yesterday was the first day of fall, so time flies when you're having fun. And Eric and I both agree we're having a ball here. All very, very interesting, intellectually challenging, and by the way, I think a lot of us are making a little bit of money here in this bull market in stocks. Well, speaking of that, where do we go from here? We're still bullish. We're still 80% probability that we're in a bull market. 20% that it's going to be the 1970s all over again because of geopolitical disturbances. The geopolitical disturbances are still, well, disturbing. So we're keeping an eye on it. The price of oil is something worth watching, and that took a dive actually. It's recently rebounded a little bit. But the 80% bull market, we had been thinking 60% roaring 2020s, just a good old fashioned, exciting decade of a bull market. So 60% we were thinking, and then 20% for, well, maybe something like the 1990s, kind of a blow off melt up. Though we don't necessarily see that melt down in that scenario. It could just be a nasty correction for a while. Now, with the Fed cutting the Fed funds rate by 50 basis points last week, which we thought was more than the economy really needs. But look, we've learned a long time ago, don't fight the Fed. Our job isn't to tell the Fed what to do. Our job is to anticipate what they're going to do. And so the markets kind of got it right a couple of days before they started to give it a higher probability of a 50 basis point cut. And so that's what we had. And our view is the economy is warm. And now with what they've just done, it's conceivable that it'll get hotter. Let me just turn this off. So it's conceivable that it'll get hotter. And in that scenario, we have to consider the possibility that the melt up is even more likely. So that's what we did. We lowered the good old fashioned, exciting, roaring 2020s to 50%, still our base case. And we raised the melt up scenario from 20 to 30%. So still 80% that we're in a bull market. And if we have a bull market like 19 in the second half of the 1990s, and I guess the question is, where are we in the 1990s? I don't think we're in 1995. I think we're more like in 1999 when you look at where valuation multiples are. But if the Fed just keeps plowing along here with more rate cuts, the market's going to go higher because there's certainly the chances of a recession. We've not been in a recession camp, and I'm still amazed. Eric and I are amazed that there's still people in the recession camp. But there are a couple still left there. But our view is Fed's easing here, and not because of the recession that they got to get us out of, but because they want to avoid falling into recession at all. So still using 5,800 for the S&P 500 by year end in the roaring 2020 scenario. But it's getting harder and harder to see what will keep this market from going still even above that level. So in the melt-up scenario, take your pick, 6,000 or higher. And then, of course, there is that awful geopolitical 1970s all over again. And that, if I had to put a number on it, somebody recently asked me to put a number on it, be something like 3,800. A lot of interesting moving parts here. Eric, you want to add anything to what I said, or should we just launch into the charts?
No, let's dive in.
Okay, good. So what the morning briefing focuses on this morning is on the Fed's dream scenario. The summary of economic projections came out last Wednesday, along with the Fed statement and the presser that Powell delivered. And in that summary of economic projections, the SEP, there was the Fed's forecasts, and in there was sort of their long-term projections of where they like to see this economy going. So let's look at that, and then along the way, kind of discuss where we agree and don't agree. Generally speaking, it's a dreamy scenario they have. We really don't have a problem with it because it's pretty much our roaring 2020 scenario. The main thing that we'll show you in a minute here is we think real GDP is going to be stronger because we think productivity will be more of a factor. The Fed doesn't seem to be willing to consider that, or that they're not going to consider it until the data actually shows it. But the fact of the matter is the data is showing that productivity is making a comeback. So let's go and have some fun here with some fun charts. And I'll open up the charts. Eric, I'll let you start off with the Fed funds rate projections that the FOMC has.
Yeah. So in this SEP, they revised, their forecasts lower. I think we were all kind of expecting that based on where inflation was coming in and where market pricing was. So currently, the Fed sees, getting to 3.4% by the end of next year, and then getting to terminal, or kind of the ultimate level of the Fed funds rate, by the end of 2026. I think the interesting thing is that the market actually thinks we're going to get to terminal, or 2.9%, in the next 12 months. So there's actually a pretty big divergence there. But yeah, what we're seeing is kind of that soft landing. We can keep cutting as inflation falls to 2%.
Yeah, and they're talking about at least another cut, either in November and December, maybe two cuts of 25 each, maybe another 50. I guess what Fed Chair Waller spoke on Friday, Eric?
Yeah, Waller spoke Friday, Bowman as well. I think Waller was trying to, his post non-farm payrolls pre-blackout comments kind of seemed consistent with 25, and it seemed like he was trying to say, no, in fact, this is why I went 50, which was really just disinflation.
Mm-hmm. So in terms of GDP, the median consensus estimate of the participants of the FOMC is not terribly creative. They got 2% this year, 2% next year, and 2% the year after that for real GDP. And oh, by the way, they think that the long run, I think the long run means sort of neutral, or where they think in the long run would be the ideal dream economy. And here on the Fed funds rate, their long run has been raised to 2.9%. So that seems to be their nominal neutral interest rate that they think, once we get there, everything will just be hunky dory, and life will be in total equilibrium, and we'll all be happy. And speaking of happiness, they think we'll all be happy with 1.8% growth in real GDP. That seems awfully low when you consider that real GDP has had a record of growing more like 3%. And a 2% forecast for real GDP is, I don't know, it's pretty uninspiring. It's basically, I think everybody would kind of agree, until we figured out how all this immigration works, that the labor force is growing about 1%, and that productivity would have to grow by only 1% in order to get their 2%. And again, history shows that productivity grows faster than that. So it's not clear why they are so high. I think this kind of just reflects their perception of what the economy was doing before the pandemic. But it's certainly had a long history of doing better than that. So our forecast is that is more optimistic than theirs in terms of maybe 3-4% growth, depending on just how strong productivity turns out to be. Here's what I just mentioned. This is real GDP on a year-over-year basis came in at 3.1% in the second quarter. And if you look at the average over time, you can see that lo and behold, it's 3.1%. There was a period here where we were doing more like 2%, and people were freaking out that 2% is the stall speed of the economy, and we're going to fall into recession. And Deni research took the position that that's just the growth of the economy. It's normal. It's not going to fall into recession. Some of you might remember, we made a list of panic attacks, all these events that occurred along the way here that convinced people we're about to fall into recession. So we've been fighting the recession crowd for a while here, and now we thought the recession crowd would disperse after the 50 basis point cut in the Fed funds rate, with the Fed making it very clear that the last thing they want now is to see the unemployment rate go up because they feel so comfortable that inflation's coming down. But So again, there's still a few die-hard hardlanders out there. Um, and we appreciate their hard work because we look at what they come up with and try to see whether there's some things we agree with and what they're missing. So figure 4 shows productivity. It's the same kind of chart. The blue lines are the quarterly at an annual rate. So you can see that's very volatile on a quarterly basis. The red line is the year-over-year percent change, and that's somewhat less volatile. But as you can see, we are now running at over 2%. As a matter of fact, it was 2.7% on a year-over-year basis. And the trend over time has been 2.1%. So, when you look at the trends over time of real GDP at 3%, as we just did above here, and 2% on productivity, that means that, if the labor force is growing 1%, real GDP should be on average growing about 3%. And by the way, this estimate of the average includes recessionary periods, as does real GDP. And if you agree with us that there's no recession for the next couple of years, then again, 3% should be kind of a normal story with a 2% productivity number. The unemployment rate looks like the Fed thinks that if they lower interest rates, it won't go up any higher than 4.4% this year, that'll be the peak, and then it's 4.3%, 4.2% in the long run. So this seems to be the so-called NAIRU, the non-accelerating rate of unemployment, non-accelerating inflation rate of unemployment. And so that seems to be their measure of what the ideal economy is. So the ideal economy is growing 2%, with the Fed funds rate down to 2.9% and real GDP and the unemployment rate at 4.2%. Inflation, we don't really have a problem with their numbers. They're using 2.6% for this year, then 2.2, then 2, and then 2 is their kind of long run outlook. And again, we don't really have a problem with that. I guess if we're surprised, we're thinking it could be deflation because of China. On the other hand, we're going to have a new administration, and it seems that whether it's Harris or Trump, they're going to promote policies that could be inflationary. After all, part of this recent inflation surge we had a lot to do with out of control fiscal policies, handing out checks to everybody and passing out spending on inflation reduction projects, whatever that means. So here's the key to our story. Our story has been that what really brought down inflation wasn't the Fed. What really brought it down was unit labor cost inflation, productivity. Productivity is the big story here. The problem with macroeconomics, the problem with economics on Wall Street is it seems to be very headline oriented. It's always about the Fed. It's always about the administration, the economic policies. and we forget that we forget all about us. We working stiffs are the ones who make this economy operate. We're the ones that hire people, not presidents. Presidents always take credit for how many jobs they've created, but we're the ones who do the hiring. We're the ones who try to grow our businesses. I recently hired Eric, and it's worked out great. So very pleased with that, and it's been good for our business, and our business has been growing. So that's the nature of entrepreneurial capitalism, and it works. And productivity is making a comeback here, and unit labor cost inflation's come down substantially. So, Eric, just I'm going to give you just a minute here just to take us through the 1990s outlook. Why it's not 1995, but more like 1999, and just how worried are you? How worried should we be about? Is it enough just to go from 20% to 30% on the melt-up scenario? Might it be a lot more? And what would the Fed have to do to convince us to raise that?
Yeah, I mean, we're definitely sympathetic to some of the views that valuations are stretched or lofty. That said, you would have been able to say that for the past few years, and yet we've continued to climb to all-time highs. So this is the Buffett ratio, comparing price to forward sales, and it's quite stretched. I think the difference in this cycle and in what we expect in a continued roaring 2020s higher productivity growth scenario is that profit margins have been expanding. Companies are able to do more and support their bottom lines based on current revenue. So when you look on a forward PE basis, valuations aren't as bad. This is a function of a couple things. It's increased innovation, better tech, but also because the market is by and large, or it's increasingly concentrated by large cap tech stocks. These are companies that are inherently more productive. They're more innovative. They can do more with less employees. So as we get that increased concentration in these companies that are, earning, their forward earnings look great. They're very profitable. The market and the economy as a whole, it's just, profit margins are just better. So if we go
So,
to, go ahead,
yeah,
Ed.
Eric, I just want to throw in there that when you look at that blue line and when you look at Buffett's ratio, which is the red line, you kind of freak out that we're all-time record high, and it's much higher than it was even in 1999 when he took the position that he's comfortable. He gets uncomfortable when his ratio goes above 2.0, and here it is clearly above 2.0. But as you just pointed out, the PE ratios aren't as high because margins have been going up, and so that's an important part of the story here. And the other thing about the PE is, as you said, the Magnificent Seven have a PE of about 30, 31, 32 thereabouts. The overall market is about 21, 22. And if you take out the Magnificent Seven and look at the S&P 493, not so bad, 18. I mean, they're not giving stocks away, but our story is you have to look at every stock as a tech stock. They either make technology or they use technology, and I guess that's the way we can justify these kind of valuation multiples, because the technology can be used to augment labor to increase productivity and keep things moving forward. We'll pass this one. This one you've seen before. This is the market cap share of the technology and communications sector. So it's also as elevated as it was back here. The difference is the earnings share of these two sectors is higher. So it's again not quite as extended, but I mean, if the market just keeps going straight up here, then it is going to be 1999 all over again. Question is whether it'll be 2000, and we're more inclined to think it could lead to a correction of sorts. Eric, what's the implications here of fiscal policy? I think we've been arguing that the problem we have with the Fed here is that not only did they cut by 50, which we thought was more than the economy needed, but the other thing is they aren't factoring in fiscal policy. Want to give us a spin here on what the where the Fed might be making a mistake here by ignoring fiscal policy,
Yeah, I mean the path of fiscal policy is expansionary or inflationary, kind of any way you slice it.
or both?
Yeah. um, the for now, right, Treasury supply hasn't been a huge issue, but we don't have to go back too far for when supply kind of overwhelmed the market. And there's no real concern, right, of an auction failing. We're not peddling doomsday or the Treasury is going to run the economy off a cliff, but it does run the question of what is the rate that investors are willing to pay. And we can already see just over the past few trading sessions, long-term bond yields are rising. And we think the market's kind of attentive to this issue that the fiscal picture is kind of inconsistent with bond yields remaining at this level. So, we'll see what happens with the election. I think we still believe there will be a split government, but you get a sweep on either side, and it's very likely that this supply picture worsens.
Yeah, and our thinking on the bond market, we thought that we're getting close to a bottom in the bond yield, and we thought that because we've been in the contrarian camp that the economy isn't all that weak, doesn't need that much easing. So I think the bond market's kind of confirming our view. The other thing is, I think we showed it yesterday in the quick takes that the bond market is very sensitive to the Citigroup Economic Surprise Index, and that's been starting to improve. The surprises are getting to be less negative, and it wouldn't take much more to the upside to turn positive. And that's the bond market on a short-term basis tends to react to economic surprises. And if things do turn out to be better than expected, we're expecting a pretty strong personal income number, for example, because that's what our earned income proxy showed. Um, but meanwhile, the fiscal policy we think just should not be ignored. And the Fed has this view that they're not political. That's fine. They shouldn't be political, but that doesn't mean that they can't be aware of how fiscal policy might impact the economy, and therefore how they might need to recalibrate interest rates. Right now, when Powell says he's recalibrated monetary policy, he basically said we're recalibrating it without taking into account whatsoever what's going on the fiscal side or what might happen on the fiscal side. So we're just giving you a monetary easing forecast through the next couple of years without kind of a blank assessment like that. Eric, just take us through some of the tools that haven't worked. This has been a pet project of ours just to fight off things like the Phillips curve, things like the inverted yield curve, and now the disinverting yield curve as being signs. I guess what's the argument here on the Phillips curve that seems to not be playing out?
Yeah, I mean the inverse relationship between inflation and unemployment. Historically, I mean, we circled it, but it makes sense that an economic slowdown would be consistent with inflation falling. Inflation tends to peak, and then the economy slows after the Fed tightened policy, and then you get that inverse relationship. This time around, no recession required. I think we've mentioned this repeatedly, but a thing a lot of people mentioned is, or a lot of people failed to realize that there's a massive recession in China. So we've had goods deflation for several quarters. We've also had weaker goods demand as people increasingly preferred services here. So you didn't need a recession stateside to bring down inflation.
And then this chart just shows that the Phillips curve notion, the simplistic Phillips curve notion seems to be the only version out there because we've seen Fed officials talk about the Phillips curve over the past few years, and they always seem to be just kind of looking at this chart, and they don't take into consideration again the productivity story. I'm not quite sure why productivity is kind of like Rodney Dangerfield. It gets no respect. Maybe people just don't believe the numbers or whatever, but there's a lot of ways to kind of cross-check that the productivity numbers makes sense. Like if productivity is growing faster than expected, we should see that in wages rising faster than prices, and that's what we're actually seeing. So we got no problems with the productivity numbers that are currently out there. And this shows that there's actually an inverse correlation between the unemployment rate and productivity. In other words, when the labor market's tight, it's hard to find workers. Companies figure out ways to increase productivity. That makes lots of sense. So the idea that a tight labor market has to be inflationary is at odds with the reality that that's not always the case when productivity is actually picking up. This is the inverted yield curve. People were freaking out about the inversion that was occurring here. We were saying that it's not going to work. At this time, we didn't think that we are going to get a credit crunch and a recession. We did have this mini banking crisis, which the Fed addressed pretty quickly, and that actually made the bottom in the inverted yield curve. And now the concern by some is that, hey, look at this chart. Every time it's disinverted, it's turned positive. We went into a recession. Well, again, what do you call that? What's our term for that, Eric? The technical analysis.
Oh yeah, the tamed the technical analysis of macroeconomics.
Yeah, macroeconomic data. It's like
Yeah.
it's happened before. It's got to happen again, and let's not think about it. Well, we try to do some thinking about it, and as you can see, that there is no recession here, and that may be one of the reasons why the bond yield isn't going down along with the 2-year rate from here, because it's disinverting without a recession, without a credit crunch. Finally, I think this is finally, yeah, we just kind of made another point on the leading economic indicators and on the MPMI. Leading economic indicators, year-over-year percent change versus MPMI. They're both pretty depressed. Leading indicators are even more depressed, but the MPMI hasn't been all that upbeat. It's been downbeat here. Now, when you look at the leading economic indicators on a year-over-year percent change basis versus real GDP of goods, it's like the correlation isn't as tight anymore. The economy has had no recession in the goods sector on a year-over-year basis. It's fine. So this hasn't worked, but this chart shows that the LEI is very biased towards goods anyways. It's just even wrong about goods this time around. Can't that really needs a product recall. And then finally, here's the MPMI, and that's been very weak and convinced people that the economy is heading into recession. And again, the correlation with real GDP of goods was pretty good, but not so good anymore. Eric, why don't you field some of the questions that you see on the Q&A?
Yeah, let's dive in. Saud has one that I can answer really quick. It's most of the recent gains or much of them have been driven by valuations. How much more room until gains from a pure valuation perspective become concerning? So on one hand, also Q2 forward earnings per share rose like 12% in the second quarter. So there's definitely an EPS story there as well. I think in raising our probability from 20% to 30% for a melt up, if you take the S&P 500's valuation from 21 to 22 with our same earnings expectations, you go from about 5,800 to above 6,000. So I think that's where we'd see a concern and see some likelihood of a correction early next year. Again, not a bear market, but just a correction. But we'll see how that plays out. Moving on to Cagdus. So Ed, what do you think long bond yields do in a melt up scenario? If a melt up materializes in stocks,
Right.
Stable yields, an orderly rise in yields, or a semi-disorderly rise that short circuits to melt up eventually. P.S. Very elegant blazer on Bloomberg today.
Thank you. I'm glad you like my blazer on Bloomberg. This is kind of like a game show, door number one, door number two, or door number three. I would have to believe that if the stock market's melting up, it's because the Fed does another 25 or kind of goes for another 50, and the bond market starts to agree with us, or already has started to agree with us, continues to agree with us that they're overdoing it, that they're going to overheat the economy, and that you can make a lot of money in the stock market in a short period of time, and maybe you get out of bonds for a little while. But I would think that we could see the bond yield go up pretty sharply, maybe to 4.5, 4.75% in a stock market melt up scenario, which would really be a dramatic steepening of the yield curve. But we'll see how that plays out.
All right, let's just take one more. I'm going to skip to Willem's. It's a pretty long question, but I'll try to summarize it. So if we're right, the economy is closer to full capacity utilization than the Fed thinks. We also argue that fiscal could be more expansionary or inflationary than the Fed believes. So the only thing that would make our economic outlook scenario look less inflationary would be higher productivity growth,
Right.
which is something the Fed doesn't appear to predict. So what are our views on the likelihood that the first rate hike will be in 2025? Or I guess a better way to ask this question is, what is the outlook for tighter monetary policy than the Fed or the market is expecting?
That's a good one, Willem. We've been thinking about that. You certainly can't rule out the possibility that the Fed would do. Powell's the great pivoter. I wrote a book called Fed Watching for Fun and Profit, and every chapter, a couple of chapters, is devoted to some of the Fed chairs we've had. And the title of the one on Powell was Powell the Great Pivoter, and he's perfectly capable of doing it again. I think his dovishness has turned to dovishness with Jackson Hole is back. It reminds me of back when he turned woke during the pandemic and said, we basically bought into DEI, and we need diverse equity and inclusion in our labor market. And he was really totally woke on it. And then suddenly he woke up to an inflation burst that he had to respond to, and forgot all about being woke about the employment situation. But yeah, look, if the Fed's overdoing it here on the stimulus side, and they're shooting for some sort of uh, neutral fairy tale Fed funds rate of 2.9%, and that's too low, and the bond market signals that's too low by bond yield going up. I think the bond yield would be kind of predicting that the Fed's going the wrong way, would have to reverse course pretty quickly here. But uh, I think we are going to see the economy respond pretty quickly to this, even the drop in interest rates we've had so far, because the Fed's actually just been a laggard, right? Because we've seen the 2-year come down and the 10-year come down ahead of it all. So yeah, I think we can't dismiss that possibility. Want to add anything to that, Eric?
No, I mean, I think we'll see what happens to inflation expectations and real rates at the long end, and that'll be the bond market's kind of take on this whole thing. But it's certainly something we're watching.
Well, thank you all for joining us, Eric. Thanks again for hosting this with me, and for doing a solo last week. I've recharged, had a lot of pasta and pizza, and feeling good. So see you all next week.
Thanks, everyone. Have a good week.
Bye bye.